Hi, my name is Jae-Ho Kim, and this is my screencast presentation for Accounting A upon the topic of adjusting entries. So what exactly are adjusting entries? Basically, adjusting entries are entries made into the general journal in order to record revenues which have been earned but not recorded, and expenses that have been incurred but not yet recorded. So why do we need adjusting entries? As companies in Australia must follow GAAP, companies utilize an accrual basis of accounting which records revenues or expenses when they're earned or incurred, regardless whether physical cash has been transferred. These adjusting entries are usually performed at the end of each accounting period. There are 4 different types of scenarios in which adjusting journal entries are performed. These include deferred revenue, accrued revenue, deferred expense, and accrued expense. Firstly, deferred revenue. Deferred revenue means when a company receives cash from the customer before the service is provided, much like how you must pay for an airplane ticket before the airline provides you their service. The initial journal entry on the 1st of July debits cash for $1,000. Revenue is credited as unearned service revenue of $1,000 as it is a liability of the company to provide the customer the service they have paid for. On July 30th, when the service has been provided, Jim can debit unearned service revenue of $1,000 as it is no longer a liability and credit service revenue for $1,000. Our next scenario is accrued revenue, which is when a company provides a service first to the customer and receives cash or payment at a later date. An example of this is if a cleaning company may bill a customer after they have finished cleaning their house, the customer now owing them payment. The initial journal entry would be to debit accounts receivable $1,000 as the customer owes Jim's photography for the service he has provided, and credit $1,000 service revenue Jim has earned. On August 30, at the end of the accounting period, debit $1,000 cash to record Jim's receiving payment for the services, and credit $1,000 accounts receivable as the customer no longer owes him. The next scenario is deferred expense. This is when a company pays for a resource before it uses it or consumes it. An example of this is prepaid phones, in which customers pay for credit before they can start using the phone. The initial journal entry in this case is to debit $1,000 prepaid rent and credit $1,000 cash. This simply converts a type of asset from cash to prepaid rent. The adjusting entry is at the end of July, in which part of the prepaid rent has been consumed, therefore becoming an expense. Therefore, rent expense debits $500 and $500 is credited from the prepaid rent. The final scenario is accrued expense, which is when an expense is incurred and paid at a later date. An example of this is paying employees' salaries a fortnight after they have completed the labor. Salaries expense is debited for $1,000 as the expense has been incurred. However, it is credited $1,000 to salary payable as Jim is yet to pay the salaries. On August 1st, this adjusting entry is to debit $1,000 from salaries payable as the salaries have been paid and Jim no longer owes them, and credit cash $1,000 to record a payment of the salaries.
Created using Powtoon.